every week we sit here to call out stocks you should buy or invest in. And whenever we go back to do a review of such stocks, we realize that they usually move based on our analysis. Now, these are not just mere assumption or guesswork. These calls are made from keen pulsating research. So based on that principle, today we'll be showing you stocks you should not buy. Yes, stocks you should not buy, especially in 2026. This is Clockwise. My name is Providence, and as you already know, I'm here with my in-house analyst. With a resounding virtual round of applause, welcome, Mr. Kanem.
Thank you very much.
Welcome to Clockwise.
Thank you very much.
Before we dive into today's conversation, I would like to ask you a question I've asked you off air. Now, let me ask you on air today. Now, why is it that you don't buy penny stocks? I've never heard you talk about penny stocks before. And people have this insinuation that when you buy penny stocks, once they are penny, and once the company blow up, they become multimillionaires. Why don't you buy penny stock on your personal note?
Penny stock, it makes me remember the expression penny wise, pound
Foolish.
Okay, so in all honesty, here is the reason why I don't buy. I've already told you on this channel that the Nigerian stock market or the Nigerian capital market is extremely shallow. What I mean by that is the depth of market is not appreciable. We are, compared to other countries, especially even emerging markets, are sitting around 80%, 70, 80%, 90% of market cap to the GDP ratio. Nigeria is 35. That shows a relatively more shallow markets than the other markets we speak of.
Okay.
What even makes it worse? So when a market is that shallow, that means capital mobilization is very it's very difficult. That's why if you observe, most companies in Nigeria are trying to be dual listed. You have like Zenith Bank, you have GTCO, like even the Dangote refinery that is coming is dual listed. You know why? Because they're trying to tap into liquidity elsewhere. So what that tells you is that liquidity is very important.
Very key.
It's very key in the market. Now, so number one, when you see a stock that is a small, a penny stock, yes, it can actually bring outsized gains.
Yeah.
But the reality is that you should understand that it's a two-way thing. A penny stock can swing, can do 50%, can go up 50% in a week, and go down
50%.
Same 50% in a week. You don't want that to be. You don't want to maintain such a portfolio. That's number one. Number two, a penny stock, because of the relatively smaller market cap, can be easily manipulated. Most pump and dump schemes actually work with penny stocks. You could see a coordinated social media hype to push a price up, then you buy at the top, and then boom, it dumps immediately. Penny stock. Then another thing you understand is that most of these penny stocks are actually companies that have terrible performance. That's just no wonder why you wanted to say that my Access Bank is a
No.
Is a penny stock.
When you are buying Access Bank, just have the assumption.
It's not. You are not buying a penny stock, guy.
But the price is a penny stock, right?
That's not. Though, in all honesty, for a bank, a tier one bank to trade, that bank is literally trading like a distressed bank. 0.3 price to book is more like a distressed bank. More,
It's not that it's a very big bank. It would have been gone by now.
Well, if in all honesty, like I said, even after the impairment charge, they were still profitable.
Okay.
But that's on the side. So the penny stocks are you can easily manipulate them. Very easily. You don't want to be in that kind of space. Then another thing is, I tell especially newbies, swim with the whales, not against the whales. So, for example, you want to go where pension funds, institutional investors,
Big guys.
and the big guys are. Those guys don't consider penny
Their
stocks.
emotions do not determine movement.
They don't consider penny stocks. So that's why you don't have so much liquidity. They don't do that because these guys come in with huge amount of money. When we talk about market liquidity, we are saying, when we say is an asset liquid, what we are saying in essence is, can I come in with a large amount of money and not move this stock price significantly? If if let's say a company is worth maybe 500 million naira, and I bring in 50 or 100 million, I will move the price by a long shot.
Yeah. And if I leave,
and if I want to exit the market,
you still move the price.
I will move the price by a long shot. Someone reported, or someone said that he sold a particular stock, and then there was a price that he thought he sold the stock, and what was transferred to his wallet, his bamboo wallet, was way less. And the reason is very simple. It's because what he thought it was the price, because of the low liquidity at the time of sale. So, for example, you could see a price at let's say $10, 10 naira per share, and then you initiate the sale order. Because of low liquidity, because what happens basically is when you are selling a stock, you are actually selling to another buyer.
Yeah.
So if there are no buyers
At that point,
that 10 naira that you're talking, the market makers will look for the next available order, which buy order, and then sell to you at that price. So you could sell something that you thought you would make $1 million naira, and you are seeing what you are saying is 800,000 or 850,000. So that is where that is one of the challenges. Then the last thing, of course, the last reason I don't buy penny stock is because of the Hotel California scenario, which I don't want. It's something that is I still have people that, against my advice, they went ahead to buy stocks with literally very, very low liquidity. Till today, some of them for the past 3 weeks they've been trying to sell. They've actually set out their sell order. It's not been activated. So you want to sit with it. There will become a time when the market depth will be so appreciable that you make a sell order and it comes out immediately.
Because I want people to understand that because the price of a stock is low does not make it a good stock.
It does not make it,
and does not mean that the stock will actually go up because the price is low. It can even go lower.
It can go lower. It can literally dump completely.
It can even go lower even though the price is low.
Because those stocks with such low prices, sometimes it could be because the investors are not seeing a prospect in that company. So you are literally like an exit liquidity for people. While they are selling the stock, you are looking to buy. And when you buy, remember, there's more sell pressure than buys. So when you're trying to sell again,
nobody wants to buy
from you. So the market will literally look for the next available. So you could be selling, you could say, this thing is like, I bought it at $5 naira. And then it's gone to 15 naira. Okay, let me sell it. By the time you sell, you realize that you are literally selling at 9 naira.
That Hotel California analogy, what did you say it was again?
You can exit. you can check out, but you can never leave. So you can you can buy, very easy to buy. You can buy a stock, but to sell and get your money back. And if you don't sell, remember, whatever you think is the paper gains that you've made,
it's just paper.
It's just paper. You cannot realize those gains until you sell and get the money in your checking.
All right, now let's focus on today's conversation. I just want to know that about you because I've not heard you mention penny stock. I'm from Access Bank. Sorry, Access School. All right, now we've talked about stocks people should buy, and if you look at it, most people have made so much gains from the calls we made because we actually look at this analysis and the movement of these businesses. It's not about you knowing the stocks to buy only. You should also know the stocks not to buy because I believe the money moves like a circle, and we should know when to invest in a particular asset based on the movement of the money. So now let's discuss the stocks you should not buy. We may not pick names,
okay,
based on certain reasons, but if we want to, if they are that bad and very obvious, so we are not trying to say, okay, this one we don't buy this one, but everybody can see that you should not buy it. So we can call those kind of names. But let's look at those indices, those pointers you look at before actually buying a stock. And when you notice this particular thing in a stock, you just don't want to take your money there.
So the thing is that I want people to understand when you buy a stock, you are buying a tiny percent of
the business. Yeah.
So just like if someone comes to you to meet you and say, please invest in my business, are you going to say, oh, because it's you, let me give you? That's why the very first people that invest in a business without any form of daily cash flow, nothing at all, they are called fools. So they say the first people that actually buy into your business are what we call friends, family, and fools. Yeah, so so that's it.
Yeah.
But as a savvy investor, you want to look at, there are some things that you look at
Before you invest in
before you invest in a business. So, for example, if you see a business having a consistently declining revenue, that tells you a business that is downhill, that is heading downhill.
Yeah.
So you don't want to go into that business because it could show that their products are no longer in vogue. It could show that because if they're not making money, if they're not, the revenue, it keeps declining. That means the company is not making as much as it is burning. So you want to avoid that, because think about it. What do you think will be the return on investment? You cannot have, for a business that the earnings keep dropping, the revenue keeps dropping
Consistently.
The value of the business will reduce.
Yeah.
And then you don't want to buy into a business whose value is reducing. So you want to look out for companies with declining revenues over a period of time, not just a one year thing.
10 years,
not just a 1 year thing. You want to look out for companies that have had declining revenues. That's why when I see some people say, I don't want to look at anything, then go to ETFs or go to broad market index. But if you want to pick a name to invest in, then you have to look at it. I look at it myself, and I believe that every investor, sometimes it doesn't even take. Nowadays, we even have language models. I will not be scared to tell people. It's a very powerful tool that you can also use, especially as a newbie, that you might not understand some things. If I talk about top and bottom lines for a newbie, you might not understand what those means. Earnings per share, and all of those things. So you could actually upload the company's report, upload it to an LLM, and then ask it some of those questions. What do you think about this? Those things, or if there are some things that you don't understand, you can ask it to explain to you, so that you invest wisely. No matter, if you don't invest while you are gambling, you're just putting it, let's see if it works. Maybe it could work, but 99.999% of the time it doesn't work. Yeah. Really. Then the next one is negative cash flow. Yeah. So if a business has a negative cash flow, for example, it's burning more than it is bringing in. That is why you said I should not mention names.
You can mention visible names. Everybody can see.
That is why we were having some difficulty with XAI.
Okay.
XAI, if the S1 filing that SpaceX did, which listed the fortunes of all the components. We have SpaceX, we have XAI, and we have X that are now bundled into SpaceX. Now, SpaceX, very fantastic. Starlink, very, very such a business. It actually brought in a ton of revenue last year. Yeah. XAI was actually burning through $4 billion. Like literally, operating loss for last year was $4 billion. So that company has been burning more cash than it's been raising. If you see a company have that record for a long time, I'm not saying that space. Of course, when you put all of them together, SpaceX, XAI, and X, that becomes one guy produces cash, one guy burns through cash. I believe over time they will smoothen things together. Maybe they'll reduce. The only thing is that Grok has not been finding a lot of favor. Anthropic has really taken the market share. So if you see a company that has negative cash flow, so if XAI went public on its own, I won't touch that company, really, because it's been burning more cash than it. So if it has a negative cash flow, you won't want to buy it, because what that means is that if there's no cash flow, especially for people that are dividend hunters. Yeah. Then when do you think
point the business will stop?
The business, of course, cash flow is the life of a business. So if it doesn't generate cash flow, then you are in for a very rocky ride. Of course, if you're especially for those
this is beyond hotel cash flow.
It is beyond hotel cash flow, especially for people that are dividend hunters. If they don't make money, they will not pay dividends. Yeah. So that's it.
Okay.
The next thing you want to look out for would be excessive debt. If a company has a large debt on its balance sheet, then you have to be very wary of that company, because debt servicing could be very, very difficult.
Focus on the
yes,
company.
Debt servicing, a lot of you could actually make the company could make a lot of money, but because of debt issues, then you could be in a very terrible situation. Let me give you an example so you think about. And by the way, it's an example that my host has been talking. Access Bank made over ₦1 trillion last year in profit, but because of the impairment charge, when you take that out, that is what actually brought in. But those they still made profit though, but it completely tanked the profit. So you realize that when a company is sitting on, by the way, this impairment charge is not like as if it's just a bad loan, that non-performing loans. That's what we mean. But for a company that has a large debt, think about it. Let me give you an example. Let's say a company has $1 billion in debt, and then it is actually paying a coupon of, let's say, or is paying interest of, let's say, 10%, for instance. That means that the company's liability per year is $100 million. Now, even if that company makes, let's say, $100 million, or let's say $150 million in revenue, that should be a huge earnings figure. But because that 100 million is already going on debt servicing, then you can have a very, very tiny margin. Out of that tiny margin, what do they have to reinvest to expand the business? What do they have to not just reinvest, to even give to shareholders if they're a dividend paying company? So when you look at some of this, so excessive debt could be one of the red flags that you should look at, and then you wouldn't want to be part of that company, because like I told you, the company must make money in order to be able to have enough to service their obligations. Then the next one is this, and which is this one actually ties into why treasury companies are really not making so much. You can see their shares are tanking. When management continue to issue new shares, it's a red flag, because a business is supposed to be creating value, isn't it?
Yeah.
So you should be making money from sale of your product or services, not raising money from investors. You continue to, when you see a business that continue to go to the market to raise money, that is not a business that is profitable.
There is no business model.
There's no business. So when you see a company, you look at last year the company was in the market. This year the company is in the market raising cash. Next year the company was in the market raising cash. Yes, I know someone will ask me, some of these AI names, hyperscalers, some of these AI names are actually in the market raising money. Yes, because most of them are in the private market. That's number one. Number two, they are doing what we call very large AI infrastructure build out, and this can take insane amount of money to be able to achieve. Those companies they are still in the building process. They are building compute capacity. They are building data centers and all of that. There will be a time over the next, let's say, 5 years. That's when you can begin to say, okay, what has come out of this build out, this AI infrastructure build out? That's exactly the point. So that's why you have to. But if they're in the public market, they have a product
to raise funds.
They have a product, but every time they are in the market to raise funds, that tells you that
they have no business.
They have no business, because the business is not generating value, which they should rely upon to be able to. Is that then the market, they are more focused on raising cash than really getting value from their business.
Okay.
Then another thing you should think about is, and this is where I see a lot of businesses, people really don't understand the negative impact of this. When you see a lot of insiders selling.
Okay, yes.
Yes. Senior management are selling, shareholders are selling, people, co-founders of the business are selling. Okay?
There's no vision.
Like they say, don't try to catch a falling knife. There's no need. If the insiders are not buying, they are selling. Then let me give you a very clear example, but this one will go away from the stock market. I remember one of the things that tanked the market for Ethereum was when Vitalik Buterin, the founder of Ethereum, or one of the co-founders of Ethereum, was selling his ETH. What does that tell you? It means that
he does not even believe in
it. It means that, well, apparently, to some extent, he was funding a lot of other things and his non-profits. But why are you selling? When insiders in a particular company sell the stock, then that should tell you that they are seeing, because they are privy to the best, the most genuine information about the business. Yes, and so if they are seeing a gloom out there, then I think you are on the wrong side of the market if you are still seeing brightness. So you should take a cue from that and avoid those stocks. So look out for companies that are selling, that insiders are selling, and there's very little buy. Then that should tell you that those companies, that particular stock, you should not touch it even with the NEPA pool. Then another thing is this: you look at the business model. Someone asked me, one of my companies, an AI startup, asked me, "What do you do?" And I told the person the guy said, you just mentioned you don't even think about it. I said, I don't need to think about it. If you need to think about what a business is doing, if a business has a complex model, avoid it.
If you cannot,
because if you cannot tell is it the customer of the business that will tell what the business is doing? That is why, let me give you a very clear example. If I ask you what is Apple selling, you just know iPhones. That's it. Very simple. It's a very clear business model. So if a company does not have a clear business model, then that company, you should avoid it at all costs, because that means that it's complicated for you to tell what they are doing. That means customers will also find them complicated. And businesses are trying to make life easier for themselves. They won't want to go and bring up a product that they themselves don't understand.
Okay.
And another one would be the number 7th here, is what I call accounting red flags. When you see a business, for example, there was a business a stock I saw, the earnings were declining, but profits were going up.
Will you want to mention
because I won't, for obvious reasons, I won't mention them. But what that tells you is that there is some manipulation
by the insider.
Yes, to show a business, because they know that customers or the investors really run after profit. But why is the profit increasing while the earnings are declining? Some of those manipulations are things you should not look out for, you should be wary of, because that shows companies that are trying to show a positive outlook, whereas the business story is because the reality is that you can't manipulate it. Profit is actually what does it cost us to get this, to get the product, and how much are we selling the product? The differential. You can't manipulate earnings, but you can manipulate profits. So when those accounting discrepancies or accounting, mishaps happen, then you have to stay away from that business, because that suggests a business that will get you trapped. And once your funds are trapped, if other people believe that business is a red flag, how then do you sell to get your money back? So you don't want to do that. Then another thing is management when the management of a business has a poor record. If the management of that business has a poor track record, then you want to avoid that business.
Okay.
One of the things I do in research, I look at and by the way, if you're a co-founder, one of the things investors will ask you is, what have you done before? If I say, I founded this company, what happened to the company? Oh, I sold the company. Why did you sell the company? So what they are trying to find out was, what's your track record? Let me look at a business as successful as NVIDIA. NVIDIA is extremely successful. Do you know that if you take out Jensen Huang and maybe bring out another person, you can actually tank that business? Jensen Huang has been very strategic. So if market has a poor management record, management has a poor record, then any business, no matter how good it is, can actually crumble under such management. So you want to look at that. That is a very important thing for you to look at. The last one I would want to mention would be the moat. I remember I've talked about this over and over again on this platform. Moat. It is one of the reasons why I lean so heavily to NVIDIA. almost every week I've been adding to Nvidia. Yesterday I added to Nvidia. People are like, this company is already close to $6 trillion, and you are still adding to it. I'm adding because Nvidia has a moat. Do you know that literally every company in the AI space, especially agentic AI, especially data centers, most of those companies, Nvidia has a very big stake. That is like that's number one. Number two, I don't know whether you listened to it on the GTC conference, the last one they just did a couple of days ago. Jensen Huang, they are now going into PCs. And just so you know, there are the laws when it comes to data center build out. There are the laws when it comes to computer and inferencing. They are now going into PCs, meaning that the end users can literally have local compute capability. That moat means that whichever part of AI that wins, Nvidia wins big time. Let me give you an example. I bought a company last week, Coherent Core. I want to also use that to explain what we mean by moat. Coherent Core sits in the middle of AI inferencing and compute. I bought Coherent, I bought Micron, I bought Vertiv. But let me just speak very briefly and show you that. Coherent has done insanely well. Micron is off the charts now. Because Micron sits, that moat is very important. That means that you are so much integrated into that ecosystem that whichever aspect of that ecosystem succeeds, you succeed. Yeah. So moat is very, very important. It's like a fortress that you build around yourself as a business. It means that it is very, very difficult. Someone asked me, why are you not selling your I trimmed Micron though, but why are you not selling out of Micron? I said, do you have a replacement for Micron? Things like Micron, I don't call them stocks, and I call them assets. It's more like an asset now. So Micron, you have Snowflakes, you have Nvidia. Those names are, because of the moat that they have, you can see how they are successful.
And you say the financials in Nigeria sits like that?
To some extent.
Because they are connected to the oil, to telecoms, to infrastructure.
But you have to know how connected you are. Because one of the companies, I'm not going to mention the name, a bank actually had serious bad loans because of their overexposure to the oil and gas industry. So you have to understand why you try to establish this moat. You have to be very careful. Otherwise, a terrible disruption can actually bring down your fortune. So moat is very important. Nigerian banks are like, if you look at the Nigerian capital market, I think banks are literally the ones that are gaining because, number one, dividend, particularly Nigerian investors hunt dividends. They look at return on equity, but dividends. So if you don't pay dividends, you are killed. So, but banks in Nigeria should begin to have moat, meaning that you extend not just into the traditional banking, you also go into the fintechs. If you see some of the banks that have fintech, those banks are very resilient. That's why you have GTCO is very, very big. You have Zenith Bank very big, and all of those things. So you have to look at those. And if they don't have that moat that we talk about, you have to take to your heels.
I think we've done justice to this conversation. And with what we've said, or what you've actually analyzed, you can now pick whatever you want, or those you should not actually invest in. You see, you have to go through this investment. You see investment as buying into a business, being part of a business. You don't just buy because you like the colors. Maybe you like the hype. You buy because you've done this analysis. So that's what we've actually exposed today. So before you buy a stock, go through these things again. I think this should be one of the most important videos on this channel. This particular video, because even if you're new to the markets, you can use this video to make important
kind of
decisions
guidelines
and also guide you. Thank you once again for coming.
You're welcome.
All right, thank you very much. Now, on that note, we'll come to the end of this episode of Clockwise. And please do not forget that if you want to be part of our community, where we teach people how to do analysis practically and also guide them on how to arrange their portfolio profitably, you can actually go to our profile page. There's a link there, a Telegram link. Click through it and it will bring you straight to our community where you meet others also that are doing the same things you're doing. Now, the market is interesting once you're doing it with people that actually have better knowledge than you. Yes. And also do not forget to like, subscribe, and put on notification bell on this channel because of the amazing content. And do not forget also that the illiterate university are not those who do not go to school or those who will not go to school, but are those who have refused to evolve as the environment is evolving. My name is Providence. I'll see you again.